All right, recording right now. This is May 31st, exam 2, chapters 3, 10, and 13. Okay. And what I did was I've posted the solutions to the practice exam. So I'm wondering if there's something particular you guys want to go over, or certain practice exam problems or homework problems you want to revisit. You can we go over the Hogel problem? Okay, I'm going to write that one down, Anusha. That's all the chapter 3 journal entries. Anything else, people? Oh, shoot, got all these people in the waiting room. So Annie is asking, are there schedules? Oh, I like these questions. Chapter 10, number 5. Okay, you guys. Schedules. Is this exam mostly math-based? I'm not sure what that means, Anusha. Let's see. Chapter 10, homework number 5. Is that the one where they lost the records? Number 15, Dayun, is that on the practice exam? And how to account for variances of quantity, price, rate, efficiency for debit and credit. Ran, you don't need to know debits and credits on the variances. That was part of chapter 10 appendix, and you're not responsible for that. Unless I misunderstood what you're talking about. From the practice exam. Okay, number 15. All right. Any other questions? And you can certainly ask them later. Okay. All right. Let's look at number 15 on the practice exam. Let's start with that. All right. Can you guys see the practice exam? Am I sharing it? Yes? No?
Yeah, I can see it.
Thank you, Bryce. Okay, let's look at number 15. Oops, there it is. Okay, so 3 potential investments. All require the same investment. All have the same useful life and have no salvage value. Expected cash inflows from these 3 projects each year are ABC. What can be determined from the information provided above? Okay. And the solution is what? Let's take a look at an example. Okay. So what do you know about these situations? So year 1 has 1,000, 2,000, 3,000. Year 2 has the same, and year 3 has 3, 2, 1. Question?
I didn't order this. What is this?
Who is talking? Somebody's chatting. That's okay. All right, we got it. All right. So what can you say about these 3 companies? What do they have in common? Go ahead and throw it in the chat. What do they have in common? I mean, these 3 projects, A, B, and C, what do they all have in common? They have the same initial investment, which we don't know what it is, but that's just equal. But what else do they have in common about their cash inflows? What do you see that they all have identical? So what's the total cash inflow, not taking into account present value for project A? And project B and project C. Yeah, Helena, good. Same total, same total. It didn't flag me that there was chat. Yeah, no salvage. That's also another thing. All 6,000. So, but year one, project C has the half of the 6,000, has 3,000. And we know that money worth now is worth more than money paid to us later because we have to take into account the interest. Year two, they all have the same. And then year three, A and B have the bigger returns, the bigger cash inflows. Okay. So the net present value of project C will be the highest is the answer because it's getting this money the first year. So that 3,000 is only being discounted for 1 year. Whereas project A doesn't get its 3,000 until year three, which means it's going to be discounted for 3 years. So more interest is going to be taken out of that. Okay. Right. And that was, who asked that question? Dayun. Yeah. Does that make sense, Dayun? So money, it's not money now. Money now would be year zero, but it's the first year. Money that they've earned, that they have coming in, the inflow, the first year is worth more money than it would be way down here 3 years out. Okay. The internal rate of return of projects A and C cannot be computed. That's not true. The net present value and the internal rate of return will be the same for all three projects. No, because you have different cash flows each year. And then both A and B, no. Right. What else? Yes, I agree, Rand. Okay. Is it mostly going to be math based in the sense of calculating variances, IRRT accounts? It's going to pretty much follow our homework in the practice exam, Anusha. Yeah. All right. All right, good. All right, got that one. Okay. Rand, do you have any concern over other variances in chapter 10? Or are you good with that? And remember, we're not doing the overhead variances. We're just doing the material variances, which is quantity and price. And we're doing the labor variance, which is efficiency. How many hours did they get the job done in? And the rate, which is the cost of the actual cost of the labor. All right. Okay. All right. And this practice exam is all multiple choice, and the test is not. We'll have a couple multiple choice, but it's mostly going to be pencil work. Okay. Let's see. Annie, in answer to your question, or Anusha, there's a couple of short answer questions. I think it's a lot of numbers, honestly. There's a couple of, now that you have the data, what does it mean type questions. We've been reviewing that in chapter 10. What does it mean when you have a quantity variance in material, but your labor rate variance is favorable? What could that mean? Not what does it mean, but what could it mean? Okay. No, I don't see any schedules on the exam. So I think it's mainly going to be calculations and short answer essays. Okay, so cost of goods manufactured, cost of goods sold. You need to know how to calculate that. You may not need to know how to make a fancy schedule. And let's go to the homework. Let's go look at the homework. I'm going to bring that up. I think I know what homework problem you're talking about. Let's see if I'm right. Chapter 10, question 5. Okay. Yeah, this one. This is a good one. Working backwards from labor variances. Okay. And I wonder if I can do, I'm looking for, No, I don't have a whiteboard on this one. Okay, let's see if I can do this. All right, let me pull this over. Chapter 10. Here we go. I don't like the solution on this problem. Okay, I'm trying to figure out if I can show it to you on, oh, here's another one. Chapter 13, question 8. 13, question 8. All right. Okay, so here's the problem, working backwards. Do I have the right one? Whoever asked for this. Was that Zamzam? Do I have the right problem? Yes, okay. I want to make sure before I launch into this. All right. So worldwide credit card uses standards to control the labor time involved in opening mail from cardholders. Incoming mail is gathered into batches. Okay. Pull this up. Incoming mail is gathered into batches, and a standard time is set for opening and recording each batch. The labor standard for the batch is as follows. So here's our standard labor hours: 1.25 hours, 1 hour 15 minutes, $12 an hour. Standard for one batch is $15. Okay. The records show the time spent in opening batches was misplaced. Okay, so we're having to reconstruct everything. However, the batch supervisor recalls that our output, remember with all of these problems, start with your output. It's 168 batches. Okay. And you've got your 3 boxes. You can't do boxes unless I have a whiteboard. Total labor spending variance, total labor rate variance. So you have to make your boxes with your solution. Okay. And we're going to do, what am I going to do here? Let me hang on just a sec. Pull this up. Do not want to mess this up. Okay. So in the chat, you've got 3 boxes here. Let's see if I can do a double screen. Okay, so if we have 3 boxes here, can you see both screens? So I can't do the boxes. Well, I guess I can. Let's just do a box. Box 1. And third. Box 2. So on a piece of paper in front of yourself, put the 3 boxes. This will, I hope, help you. In box 3. Now, under the box or over the boxes, you can do it that way. What goes over box 1? What's the formula that goes over box 1? It should be standard quantity. Standard quantity times standard rate, right? And over box 2 should be actual quantity times standard rate. And over box 3 should be actual everything, okay? Actual quantity times actual rate, okay? Now, when you're doing this for the exam, there won't be any boxes, there won't be any template for you to fill out, okay? So that's why I'm saying no, Tegan. You don't need to worry about drawing the boxes. I mean, you can do anything you want on the exam. I'm just concerned about your final number and show me your work, because if you mess up partway through, I have the chance to give you partial credit. I use the boxes because I'm a graphical organizer person. Not everybody is. Some of you just prefer the straight algebra, and that's fine too. Okay. So, but notice that on the right side, you've got all A's, actual quantity, actual rate. And on the left side, you have standard quantity, standard rate. And it's here, this is with labor, okay? This is with labor. We don't have to split the box with labor. Okay, so we just have to show it as is. So I'm gonna, we've got our standard, but the first thing we have to do on all of these is talk about output. So in this problem, our output is 168. Okay. All right. But what do we know? The problem says the problem's given us standard hour, standard rate. And then the other thing is it says, what is labor spending variance? What is labor rate variance? Now, what's missing from this number? So read these carefully. What the heck? We know what labor rate variance is, right? So if we come over here, I'm going to put these up here. Right down here, yeah. So we know, where does labor rate variance go? It's the difference between these two variances, okay? So labor rate variance is going to be $150 favorable. But what is labor spending variance? What do we do with labor spending variance? That's a tongue twister. Labor efficiency, good, Jared. So we don't know what that one is, okay? It's missing. All we have, so let me back up here and say we've got an unknown. So we've got that one we don't know. This one we do know. No, labor rate variance, favorable. What the heck is labor spending variance? Put it in the chat if you know. What is labor spending variance? Put it in the chat if you know. Price times quantity? Nope. This might be a trick question. We haven't really talked about this term. Labor spending variance is 330 and it's unfavorable. What is it? What is labor spending variance? Labor rate, Zamzam, you're correct. Labor rate variance plus labor variance plus labor, wait a minute, finish that one. Labor rate variance plus what? So labor spending variance is going to be
labor efficiency variance plus labor rate variance.
good. Yeah, the two combined equal 330 unfavorable. So what does that tell you that labor efficiency variance has to be? So if X plus a favorable variance, so remember favorable variance, yep, you got it, Otto. We write the favorable one like that. This has to be positive, which means it increases cost. So now we know labor efficiency is unfavorable. Okay, so we've solved for part of this problem, but that's not the question in the problem. Okay, all right. All right, so the question in the problem is determine the actual labor hours spent opening batches during the week. You know that this is the favorable labor rate variance, which is going to be the difference between these two. And we're trying to solve for the actual hours here. That's our unknown. Okay. If we know this, what's our next step? Anybody have any ideas? So Anusha, the way we learned it was the actual quantity times the actual rate is the rate variance on the right. Oops. Right. Okay, so if we know what this is, we know that the combined effect is 480. Let's work with the first box. Let's get the total for the first box. If our output is 168, right? And we know that our standard quantity is $1.25 times 12 is 15, right? Times 12. We know that we should have spent, to do this, let's see if I can do that math in my head. We should have done how many hours? 168. So it should have been 210 hours times $12 an hour. And that's going to be 2520. So the standard, if we know that this is the standard 2520 in here, I don't think I can write in here, but I could try. Nope. Yeah, I can. 2520 is what we should have spent. And if we had an unfavorable variance, that means that we spent $480 more than 2520. Okay. And that's going to be 3,000. You guys with me? All right. So we spent 3,000 at the standard rate, right? Should have spent 2520. So how many hours is 3,000? Okay. How many hours did it work out at the standard rate? So let's take that 3,000. That was our total. And we're going to divide it by what? What are we going to divide it by to get our actual hours spent? Yes, I'm not paying attention to the chat. I should. So what do we have there? 3,000 divided by 12, and we get 250 hours. Okay. So that is the answer to that's the actual labor hours spent. So we actually spent 250 hours.
Judith, I have a question.
Go ahead.
For 480, how do we know it's unfavorable?
Good question. So how do we know it was 400? We knew the combined was 330 unfavorable because the problem gave us that. They said labor rate variance is 150 favorable. So remember, we show that as a negative because that reduced costs. The combined variances of the efficiency and the rate are 330 unfavorable. So in order to get to 330 unfavorable, we know we just back into, we say 330 minus a minus 150 equals 480. So the difference. So think of it as a number line. You had 150 favorable, but the combined was 330 unfavorable. So you must have had an even bigger unfavorable efficiency variance. So this was All right, so now we know 250 hours. We don't know what the actual rate is, but we do know that the labor rate is 150 favorable. Okay. All right, so how do we get to 150 favorable? It's the difference between 3,000 and whatever this total is. Okay, so 3,000 minus 150 is going to be equal to 2,850. Okay. Okay. So then you just say 2,850 divided by 250 hours, and you come up to something like what? What's our total here? What's our actual rate? We say, yep, Pam, you are correct, 1140. Okay. So the tricky part here, guys, is working with these two givens. We were given these two numbers. We had to calculate this number. And then once we had that number, we were able to calculate this number just based on what the problem gave us. Remember, we just said output, we always start with output, and our output was 168 batches. So we came down here and we said 168 batches times the standard hours, an hour and a quarter, and the standard rate. And that's how we got the 2520. Then once we knew the unfavorable was $480, we knew what the total was, and we could back into the actual hours worked. Okay. So then once we know the actual hours worked, we say 250 times X. How did we get this number? We calculated the 2850 by saying 3,000 was the actual hours at a standard rate, but we had a favorable variance, so it had to be less than the standard total. And we backed into it. Okay. That's a good problem. And then Anusha, you had any more questions on that problem? Everybody good with that? Yeah, let's see if I can go. Sure.
Judith, just a quick question. Will there be a job cost sheet on the test?
No, there will not be.
Okay, thanks.
You may have to calculate the total cost of a job, but you won't be filling out a job cost sheet.
Okay, thank you.
But okay, Anusha, I want to I just want to show you this one. Let's see if I can. We're in chapter 3, and the question is about the Hogel problem. But the whole answer is starting on page 109 here. So here's the problem that I gave you on the practice exam, and then here's all the solutions. I thought I put that on the solution manual, but maybe I didn't. I thought I put that in the solutions, but here's all the solutions. Knowing how to do the journal entries, post to the T accounts, figuring out if manufacturing overhead is over-applied and under-applied, and prepare a journal entry to close everything to cost of goods sold. Don't allocate it. So do the easier method. Remember when we have over, under-applied overhead. And then how they, in this problem, they ended up with a $20,000 credit balance. And then our last journal, sorry, this is jumping around here. Our last journal entry is to clear it out. So if you have a credit balance in manufacturing overhead, you will debit it and credit cost of goods sold. If you have a debit balance in manufacturing overhead, you're going to credit manufacturing overhead and debit cost of goods sold. So you can see here, this credit to cost of goods sold, it's actually going to lower the cost of goods sold. Originally, you had 870. If we go back to the T account here, it was 870, but it's actually only going to be 850,000 in this example because you had over applied overhead. Okay, so just be able to calculate those. All right.
But then if it's
Right.
underapplied, it's vice versa, the journal entry.
Correct. Yeah. And the one we did in class in our course pack was under applied. So this is a good example of the other direction. So yeah, I think we had in our example in the course pack, we had you can see it is right up here. So we had 5,000 under applied. So when we cleared it out, we credited manufacturing overhead. And then down here with cost of goods sold, we had to debit cost of goods sold and make it higher. Okay. So, right. Okay. All right. I have any more questions on chapter 3? This is a great problem, and that's why I just put the whole thing in there, and it's good practice. So any other questions on chapter 3?
I'm not sure if you're allowed to answer this, but for chapter 3, is this kind of the main problem from this chapter that like
That's pretty much everything out of the course pack, Anusha. And that's pretty much what we did, with the exception of filling out the job order form. And then there are some theory questions in chapter 3, but they're pretty high level. So I think, but yeah, and calculating overhead, you know, how do we calculate the other question from chapter 3 is understanding how to get to the predetermined overhead rate, you know. And if we think about, you know, what accounts are, and then so there we go. Predetermined. Can't spell either. Okay, how do you do that? What's the predetermined overhead rate? What's the formula for that? Do you guys remember? Go ahead and put it in the chat if you remember. What's the predetermined overhead rate? Annie, yes, estimated total manufacturing overhead, estimated total allocation phase. Good, good, good. And then the question is, there we go. Okay, so when you're figuring this out, make sure it's manufacturing costs. Okay, you can have similar costs, but they don't necessarily. Let's do a practice one of that real quick, and then we'll move over to chapter 13. So if you guys have your course packs handy, turn to page 37 in your course pack, and let's do a practice problem on that. Page 37 in your course pack. The Simmons Company. I don't think we did this in class. Okay. All right, so at the top, it doesn't say calculate the predetermined overhead rate, but that's what it's asking. So these are estimated costs at the beginning of the year. They're estimating 40,000 labor, 64,000 machine, show your calculation. So this question here is saying, what is the predetermined overhead rate? So see if you guys can work on that for 1 minute and see if you can give me that rate. I'm going to set my timer here. 1 minute, what is the predetermined overhead rate? Okay, here we go, starting now. Okay, you've got, I have to do it too. I don't remember the answer. If I can do it over here, let's see. I keep bringing this stuff over, sorry. Mm. Oh man, time's up. Did you guys get it? I didn't get it. Let's see. Cole, I don't think that's right, but let me check. Let's take another 30 seconds and see if we can get it. No, I got the right answer. I remember it now. Yeah. Okay. We have 2 more answers. Jared, you're correct. Helena, you're correct. Okay. So anybody else have a guess? Not anymore, right? These guys are correct, right? Okay, here's my math. So this is the tricky part. What is included in manufacturing overhead? Okay, direct material, direct labor are not manufacturing overhead. They're direct material and direct labor. Sales commission has nothing to do with manufacturing, and it's going to be, let's see if I can separate this guy. And then they give you this extra. So then sales commission, no. Salary of production supervisor, yeah, it's part of production. Indirect materials, yes. Advertising expense, no. Rent on factory equipment. If you had depreciation on factory equipment, same deal. So you add up these 3 numbers and you say the total is estimated manufacturing overhead for the year. And then it's estimated allocation base, which in this case, overhead's applied on basis of machine hours. What's the overhead rate? 350. Okay. And then they say, at the end of the year, this was their actual cost. Was overhead under or over applied and by how much? Okay, so let's see if you guys can do that piece. You have 2 minutes to tell me, was it over or under applied and by how much? Okay, starting now. Got it. Okay, what's in the chat? Anything in the chat yet? Yes, you're right, Cole. Okay. Anybody else get that answer? Oh, no, you're not right, Cole. Sorry. Anybody else have an answer? Okay. Jared and Helena, no, not correct. All right. All right. What have you got? What else? Anybody else? Okay, so here's the solution. Put it up here. Okay. So again, with our solution, we're going to do so that we're going to use those same cost allocation, cost categories. So the production salary, the indirect materials, and the rent, but only for the rent for the factory. Those are actuals now, and that totals up to 234,000. Okay. But we have to figure out what we've applied to job orders. So up here, we've said this is our predetermined overhead rate up here. We calculated it, here it is, 350. And then we say, what were our actual machine hours? We actually worked 60,000 hours. So we're going to say we're going to apply to the jobs. We don't know what the jobs were. We don't get that level of detail here, which is why I don't want you to do job orders on the exam, because that'd be probably a lot of job orders. But we know we worked 60,000, we had 60,000 machine hours times our predetermined overhead rate of 350 is $210,000. So you take the difference between these three actuals add up to 234 actual, but we only applied 210. So Cole is correct. We under applied by 24,000. So overhead, here's where we applied it. We credited 210. It was under applied. I'm sorry, we under applied it by 24,000. Okay. And by how much? Show your work on 2 T accounts, one for overhead and one for work in process. So what would work in process look like? What's the ending balance in work in process? What's the ending balance in work in process? If this is overhead, what's work in process? Well, we would take, don't forget, you've got direct material, direct labor, manufacturing overhead, and now we've got 65,000 in direct material. We've got 218,000 in direct labor, and manufacturing overhead is going to be what we applied. So it's going to be 493,000. So know how to do both pieces of that for chapter 3. Okay, any other questions? Right, we've got about 13 more minutes. And Jordan, what was the question you had? You had 13 dash something. 8. Okay, let's pull it up. And come on, come on. Ignore cash flows. Okay, so here's, can you see it? Mountain View's purchased new lab equipment for 134. That's a cash outflow. Equipment is expected to last for 3 years and to provide cash inflows as follows. Assuming the equipment will yield exactly a 16% rate of return, what is the expected cash inflow for year 3? Okay, so we did a problem like this in the course pack. And if the hurdle rate is 16%, and for any problem, and we want exactly the hurdle rate, what do we know? What do we know net present value has to be if we do this? What does net present value have to be to get to that hurdle rate? So if I said to you, net present value is 0, what does that tell you about the hurdle rate? You guys are very quiet. What does it mean when net present value is exactly 0? Okay, what does it mean when what does it mean? Now, don't worry, Anusha, don't worry about IRR, but net present value, they're saying we want exactly a return of 16%. So the way present value works is we build in the hurdle rate to the problem. So if net present value is exactly 0, that means we got exactly our discount rate. Okay, so when you set this problem up, you're basically saying, I want net present value to be 0. I want NPV to be 0. So we're going to use 16%. We're going to use 16%, and we're going to look up the factors for 16%, 1 year, 2 year, and 3 years. Okay, can you guys give me the factors for that? And by the way, I will give you tables on the exam. So what are the factors for 16%? No, you can't look that up because I didn't give that to you. Let's see. Let's see if we can get that from the book. Let's see. What pages would that be on in your book? That I don't remember. Did we get those in the book? don't know. Does anybody have their book open? I need the present value tables. No. Not gonna happen, not today. All right.
It's page,
Ah, here we go. 629.
yeah, 628.
All right. So look on page 629 in your book, and I want 16%, 1 year, 2 years, and 3 years. I want the factors for those. I can see them in my book, but I want you guys to look them up. One year, oh, thank you. 0.862. 0.743. There we go. Let me get that one. All right. Got it. Okay. Year one, you have a cash inflow of 45,000. Year two, you have a cash inflow of 60,000. Right. Okay, so let's set this problem up. Okay. So here we go, cash inflow. So just like we are always doing for these problems, check my time. Yeah, I got another meeting. So this is your time or your year here. This is your dollar amount, not counting discounts, not discounted. And here's your factor. Okay. So there's your dollars. And now we're saying, hey, remember when you spend the money now, that factor is in today's dollars. So that's just going to be ×1. So we have a cash outflow. But these other items, they're going to be discounted. And they're going to be discounted. And we don't know what this is. This is what the question is asking us. What does this thing have to be? What does year three, and that's what it's saying. We want exactly a 16% rate of return. What is the expected cash inflow for year three? And the question, and we don't know yet, but what we do know is that net present value has to be 0. Okay. So we did a problem like this. So let's add up these 3 numbers. So let's just add these 3 numbers up real quick. And we get 51,280 right now. Okay, minus 51,280. So we know if this year 3 number is a positive 51,280, we'll get a present value of exactly 0. Okay, so let's just put it in there. Okay, and then okay, so we know that this, but that's not what the problem's asking us. It's saying, what is the expected cash inflow for year 3? We need to know what this number is as well. Okay, just the inflow. This is they're not asking for the net present value. They're asking for the expected cash inflow. Okay, so we know that this number times the factor equals 51,280, right? So all we have to do is say 51,280 divided by this is going to be 80,000. So our answer is 80,000. Okay. So go ahead, Chair.
I have one more quick question.
Mhm.
It's in chapter 3. For salvage value, do you use that when you're payback period? Do you subtract the salvage value from the initial investment before you?
Yes, yeah. You do, yeah. That's chapter 13.
Yeah.
Yeah. Yeah.
Okay,
Because it reduces your outflow.
but you do it with so like if the initial value of the product you purchased, not the previous one, right?
Okay, so it's all a function of time. When do you get that salvage value? If you're replacing an item and you get the salvage from the old item right away, you would subtract it right away. If you don't get the salvage till year 4, you have to wait till year 4. So it's you know how you have all the years laid out, you have to put it in the year that you get it.
Okay, yeah, I'm just talking about on 13.7. Do I use the salvage value of the?
Let's see, the right, it would have a 10 at the end of its 15-year life. So you'd put it at the end of 15 years, not at the beginning.
Okay, so basically the answer to one would then be 450,000 divided by 63,000.
No. So let's, I have another meeting. Look up the definition of payback. What are the items that go into payback? Not all these items go into payback.
Okay, so would it be like 450 times 10%, 450,000 times 10%, and then subtract that from the 450,000 and then divide it by 63,000?
I don't remember what the solution is. Let's take a look. I have to go to another meeting, so let's just do chapter 13. Let's take a look. The payback is, are you asking what is payback?
Yeah, so would it be like 6.42 or?
The payback is 5 years. Okay. And I have to go, I have another meeting, so. And I have other office hours in a half hour, so.
Okay,
All right. I'll have office hours tomorrow morning too, so.
okay, thank you.
All right, guys, see you later. Thank you for coming and see you later. Bye-bye.